Have you ever wondered what truly drives stock prices up and down? It's not just company performance, interest rates, or economic data. At the heart of it all, two emotions silently control the markets: fear and greed. These emotions dictate how investors behave. They drive decisions that create massive booms and devastating crashes. Understanding them is key to understanding how markets actually work. You see, the stock market isn't always rational. Even the smartest investors fall prey to emotion. When times are good, greed takes over. When things turn uncertain, fear spreads like wildfire. And these emotional waves shape the rise and fall of entire economies. When people feel confident, they invest aggressively. They buy more stocks, push prices higher, and fuel optimism. But when uncertainty hits, bad news, recessions, or global crises, that optimism quickly turns to panic. Investors rush to sell, markets collapse, and fear dominates. Fear is one of the most powerful forces in finance. It often strikes suddenly, triggered by uncertainty, bad headlines, or falling prices. When investors see red numbers on their screens, they react instinctively, sell before it gets worse. But this reaction often makes things worse. Panic selling drives prices down even faster. And as prices fall, more investors panic, creating a vicious cycle. This is how fear creates market crashes. Take the 2008 financial crisis as an example. As housing prices collapsed, panic spread across Wall Street. Banks were failing, news headlines were terrifying, and fear dominated. Investors pulled their money from stocks, triggering one of the biggest sell-offs in history. In the end, trillions of dollars in value disappeared, not just because of economics, but because of raw human emotion. Fear doesn't just move markets, it feeds on itself. Once it begins, it spreads rapidly, creating chaos even where fundamentals are sound. That's why fear is contagious and dangerous. On the opposite side of fear lies greed, the emotion that inflates markets beyond reason. While fear destroys value, greed inflates it. It's the emotion behind risk-taking, speculation, and overconfidence. When investors see others making money, they want in. This is called FOMO, the fear of missing out. Ironically, it's fear again, but fear of missing opportunity. This drives people to buy assets even when prices are already sky-high. Greed convinces investors that the market will always go up, that they're smarter than everyone else, and that the rules of economics somehow no longer apply. The dot-com bubble of the late 1990s is the perfect example. Investors poured billions into internet companies with no profits, no solid business models, just hype. Stock prices soared purely on excitement. And when reality set in, those inflated values collapsed overnight. Greed created the bubble. Reality destroyed it. The same pattern repeated with the 2021 crypto boom. Prices of digital coins skyrocketed not because of intrinsic value, but because of hype and greed. Everyone wanted quick riches until the market corrected. When greed turns to fear, the fall is always brutal. Fear and greed don't just alternate, they feed off each other. When greed dominates, markets overheat. When fear takes over, they overcorrect. This back-and-forth cycle creates market volatility. Every bull market eventually gives birth to a bear market, and every crash eventually plants the seeds of recovery. Understanding this emotional cycle is how great investors stay calm while others panic. They know as markets swing between these extremes like a pendulum. That's why Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." But simple advice is hard to follow when millions of dollars are at stake. The human mind is wired to respond emotionally to gain and loss. We feel the pain of loss twice as strongly as the joy of gain. That's why people panic sell too early and buy too late. This behavior isn't stupidity, it's human nature. Our brains evolved for survival, not investing. The same instincts that helped early humans escape danger now push modern investors to make impulsive financial decisions. When danger appears, in the form of a market crash, our brains trigger the same fight-or-flight response. We want to flee the market, not realizing that patience is often the smarter move. Successful investors understand this. They train themselves to stay objective when others panic. They study history, track data, and follow logic over emotion. They know that markets recover, that crashes create opportunities, and that discipline is worth more than speed. Even in the age of AI and algorithmic trading, fear and greed still dominate, only faster. Today, algorithms detect emotional signals from tweets, headlines, and even global sentiment. A single rumor can move billions within seconds. The tools are new, but the psychology is timeless. The recent GameStop and meme stock events showed this vividly. Social media amplified greed, small investors coordinated, prices spiked, and algorithms reacted, creating feedback loops that pushed volatility to extremes. When institutions sold into those spikes or when leverage unwound, fear rushed back in, creating violent reversals. That interplay of crowd psychology, social proof, and automated trading is the modern face of fear and greed. There are also quieter ways emotion shapes markets. Anchoring makes investors cling to past highs, refusing to sell losing positions. Herd behavior pushes people to follow the crowd because social proof feels safer than standing alone. Loss aversion ensures that even slightly negative news can trigger outsized selling. Behavioral economics isn't just academic theory, it's visible in every market ticker. So how do you act differently? The only real edge an investor has is emotional control. Recognizing when you're acting out of fear or greed is the first step toward better decisions. Are you buying because of hype or because of research? Are you selling because of panic or because your data supports it? Practical habits help. Set clear rules before you trade. Define entry and exit points. Use dollar-cost averaging to avoid timing the market. Rebalance portfolios regularly, and keep a long-term plan. Use stop losses thoughtfully, but don't let tight stops force you into selling during temporary noise. Diversify across assets so one panic event doesn't wipe out everything. These aren't guarantees, but they reduce the chance that emotion will drive your actions. Control of information matters too. Media amplifies emotion by focusing on extremes. Headlines sell clicks, and clicks push narratives that trigger emotional responses. Limit exposure to sensationalist coverage during volatile markets. Instead, focus on fundamentals: earnings, cash flow, valuations, and long-term trends. In the long run, patience and discipline outperform panic and impulse. Compounding rewards those who stay invested. Crashes often provide the best opportunities for those who can remain calm. Legendary investors didn't become wealthy by reacting to headlines. They stuck to principles during storms. Fear and greed will always exist. You can't remove them, but you can learn to understand and master them. The next time you see a crash or rally, remember, behind every move are millions of emotional decisions. Control your fear. Channel your greed. Think long-term. Because in finance, patience and understanding always win over panic and impulse. There's a lot more to discover about how psychology drives money, and understanding it is the first step toward mastering it. So keep learning, keep questioning, and keep exploring the hidden forces shaping the markets, right here on Wealth Lens.